Welcome to Financial Self-Defense, where we explore why securing credit before disaster strikes is essential. In this video, we will show how credit access tightens during crises like job loss, why banks prefer lending to those who appear not to need it, and how to strategically set up lines of credit while your income is stable. We will compare secured and unsecured lines of credit, decode fees, explain lender monitoring practices, and map out a step-by-step plan. Now, let's begin with today's agenda so you know what to expect. Here's the agenda. First, we'll cover the brutal truth about credit access during a crisis. Next, we will distinguish between secured and unsecured lines of credit. Then, we will break down the myth of inactivity fees and the reality of other costs. After that, we will explore how banks monitor accounts and when they may reduce limits. Then, we will go through a practical, step-by-step plan to set up credit armor. We will reinforce your learning with a couple of quick quizzes. Finally, we will wrap with key takeaways you can implement immediately. The brutal truth is straightforward. When you lose your job or experience a financial emergency, the ability to secure a new line of credit often vanishes overnight. Banks favor lending to borrowers who appear stable and do not urgently need funds. Therefore, you must set up your safety net while your employment and income are strong. With that reality in mind, let's transition to the critical distinction between secured and unsecured lines of credit. Let's compare secured and unsecured lines of credit. A secured line of credit, such as a home equity line of credit, uses collateral like your property. Because of the collateral, interest rates are often lower, and limits can be higher. However, these products may include closing requirements and draw provisions. On the other side, an unsecured line of credit relies on your credit profile and current income without collateral. As a result, rates are typically higher, limits may be lower, and most importantly, approvals tend to disappear immediately after a job loss. Now that we've clarified the types, let's visualize the decision process with a diagram. The best time to secure credit is while you have stable income. Approvals are easier, rates may be lower, and limits are often higher. This proactive approach helps you avoid last-minute panic if layoffs occur. The flowchart shows a practical path. Start from your stable income today and determine whether you already have any lines of credit. If not, consider applying for an unsecured line of credit. If you own a home with equity, consider adding a HELOC. Review terms and fees, confirm whether there are any draw requirements, and maintain low utilization with on-time payments. By following this process, you assemble credit armor before a crisis. Next, let's demystify fees and inactivity myths. Fees are not always obvious. Annual or maintenance fees are common on high-limit unsecured lines and some HELOCs. Inactivity fees are rare, but it is still essential to confirm there isn't one hidden in the agreement. Early closure fees can be charged if you close the account within a specific period, often 24 to 36 months. Some lenders impose minimum draw requirements with penalties if you fail to draw a specified amount. Rate structures are frequently variable, tied to prime plus a margin, and may include temporarily lower promotional rates. For HELOCs, there can be appraisal and closing costs, though some are waived and later recaptured if the line is closed too soon. Now, let's discuss how banks monitor accounts and why limits can be reduced unexpectedly. Banks rarely demand frequent income verification after the initial approval, unless you request a credit limit increase. However, lenders routinely conduct soft credit pulls to monitor risk. If they detect sudden warning signs, such as significant drops in available credit, new high-interest debt, or changes in your reported employment status, they may reduce your credit limit or freeze the account even if you have not missed any payments. This means your safety net can be curtailed without warning. With that in mind, let's expand your understanding with a mind map of credit self-defense strategies. This mind map places credit self-defense at the center. The Build Early branch highlights applying for credit while employed, diversifying between unsecured and secured lines, and maintaining low utilization. The Choose Wisely branch focuses on selecting the right product type, understanding rate structures, and scrutinizing fees and terms. The Maintain Health branch emphasizes on-time payments, ongoing monitoring of your credit reports, and avoiding high utilization. The Prepare for Shock branch encourages maintaining backup savings, planning for liquidity needs, and proactively communicating with lenders if circumstances change. The Risk Signals branch reminds you to watch for employment changes, rising balances, and reduced available credit. Now, let's test your understanding with a quick quiz. Question: when is it typically easiest to get approved for an unsecured line of credit? Options are A, right after a layoff. B. During stable employment. C. After maxing out credit cards. And D. When your credit utilization is above 80%. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. During stable employment. Lenders prefer applicants who demonstrate steady income and lower risk, which improves approval odds and may qualify you for better rates and higher limits. Now that we have reinforced that foundation, let's move into a practical, step-by-step strategy to establish your credit armor. Follow these steps to build your credit armor. First, audit your credit by pulling your reports and scores from all major bureaus. Second, decide which products fit your situation, such as an unsecured line of credit, a HELOC, or both. Third, compare lenders by examining rates, margins, fees, and any draw requirements. Fourth, apply while you are employed, providing documentation of income and assets. Fifth, accept prudent but sufficient limits, targeting the highest level you can responsibly manage. Sixth, set rules for yourself. Reserve the line for true emergencies and maintain low utilization. Seventh, enable alerts to monitor utilization and credit score changes. Eighth, reassess each year to review terms and confirm there are no new or changed fees. Next, we will chart how you might allocate emergency funding sources with a pie-style overview. This pie chart presents a sample emergency liquidity mix: 40% HELOC availability, 35% high-yield savings, 15% unsecured line of credit, and 10% other instruments such as short-duration treasury bills. The idea is to balance immediate cash with contingent credit options while keeping borrowing optional and controlled. Now let's address a controversial but practical tactic regarding limits and fees. A practical and somewhat controversial strategy is to secure the highest responsible limit while you are still employed. Treat any annual fee as an insurance premium for access to liquidity. Avoid using the line of credit unless absolutely necessary, and keep utilization near zero to maintain a strong credit score and preserve future borrowing flexibility. With strategy in mind, let's reinforce your understanding with one more quick quiz about fees. Question: which fee is more commonly encountered than an inactivity fee on lines of credit? Options are A. Annual or maintenance fee, B. No fee guaranteed forever, C. Guaranteed zero closing costs, and D. None of the above. You may pause the video now to consider your answer. We will discuss the answer in the next section of the video. The correct answer is A. Annual or maintenance fee. These are more common than inactivity fees, particularly on high-limit unsecured lines and certain HELOC products. Now, before we wrap up, let's include an important disclaimer to ensure you apply this information appropriately to your situation. This material is for educational purposes only and does not constitute financial, legal, or tax advice. Individual circumstances, credit profiles, local regulations, lender policies, and prevailing market rates vary widely. Consult a qualified professional who can evaluate your specific situation before making decisions. With that context in place, let's summarize the key points you can act on today. Here are the key takeaways. First, secure credit while your income is stable. Second, understand whether a secured or unsecured product fits your needs. Third, remember that annual fees are common and can be treated like an insurance premium for access to liquidity. Fourth, banks monitor risk and may reduce limits, so maintain strong credit health. Fifth, use lines of credit sparingly and keep utilization low. Finally, review your terms annually and remain prepared. To recap, lenders prefer extending credit to borrowers who do not appear to need it, so you should act before a crisis. Approvals for unsecured lines of credit shrink noticeably after layoffs. HELOCs often offer lower rates and higher limits but require careful review of terms. Inactivity fees are uncommon, yet annual and other fees are widespread. Lenders can conduct soft pulls and reduce limits without any missed payments. Set disciplined rules. Obtain the highest responsible limit, keep utilization low, and reserve the line for genuine emergencies. Thanks for watching. If this video helped you think about building credit armor before a crisis, please like the video, share it with someone who needs it, and subscribe for more practical finance content. Tell us in the comments, what's your plan to secure credit before the storm hits, and what questions should we cover next?